Welcome to risk management that equates to profitability. I'm not going to waste a single second of your time or my time. Let's get straight to the point. You guys already know what this is about. I'm going to break down everything about risk management that I know, what I use. I'm going to cover some methods that you can employ based on the teachings of professional traders such as George Soros, Richard Dennis, ICT, Ed Koda. There's a whole bunch of people who have posts, podcasts, interviews, books, really important information about how risk management carried them to profitability. I'm going to teach you guys all about that. This is a quote I like very much. And if you guys want some sort of motivational quote, you can take this or put this somewhere. It's not whether you are right or wrong that's important. It's how much you make when you're right and how much you lose when you're wrong. This is in The Alchemy of Finance. Now, I didn't read this entire book, but I have read a good amount of pages and most importantly, kind of like a summary snippet of the most important parts in that book. It is a very good book. There are many very good books out there, but let's get straight to the point. Straight to the first slide. The profitable equation. What is the profitable equation? Profitable equals net wins greater than net losses. In other words, the total amount of your wins versus the total amount of your losses. As long as this one is bigger than this one, congratulations, you are profitable. If you can do that over a long period of time, then you're consistently profitable. If you can do it to the end of the time, then you're a really good trader. So, therefore, based on this equation that is completely 100% true, no one can argue that this is the equation for profitability. To be profitable, you have two things that you could possibly do: maximize wins and minimize losses. There is no other factor to profitability besides wins and losses. Yes, you can look at stuff like risk to reward and win percentage, but none of that stuff matters. What matters at the end of the day is your net win and your net losses. Everything else, that's fluff, right? I'm not saying risk reward doesn't matter and win percentage doesn't matter. I'm just saying at the end of the day, what matters is the net wins of all your wins and the net losses of all your losses. And what I'm going to teach you in this video is my current system and also other ways that you may want to employ for your own trading to maximize wins and minimize losses. So we're going to do a little bit of a lecture in the PowerPoint and then we'll get to some chart examples and I'll give you guys some trade examples of myself as well. So let's get straight to it. Okay, so when it comes to maximizing wins, how can you maximize your winning trades? First, you have to identify signatures of a high probability winning trade. Now, I'm talking about signatures while you're inside the trade that tell you this trade is likely to continue playing out, right? And continue towards whatever target you may have. Why is this step one? Because how are you going to add to a winning trade if you can't even identify a winning trade? How are you going to let winning trades play out if you can identify a potential winning trade? Now, the goal isn't to always know which trade will play out and which one will not. Sometimes you're going to add to a trade and you'll lose. Sometimes you're going to add to a trade and you'll win. The goal is to find signatures in price action from your trades and your journaling that tell you this trade is more likely to play out than fail. And that's it. As long as you can say that this one looks better than most, that's the one that you are going to look to increase the winner. Whatever happens after the fact, out of your control. As long as you do this over a long period of time, you will be maximizing your wins. And like I said, it's all about net profit. So what can you do? 1, you can add to high probability winners. 2, you can let high probability winners play out. 3, you can have runners on high probability winners. And 4, I'm going to teach you guys the TP method, which is something I used to use. It's kind of, to be honest, a cheat code, but whatever. I'll teach you guys that. And now let's talk about minimizing losses. So on the opposite side of the equation part 1, maximize wins. Equation part 2, minimize losses. And if you can do both of those things really well, you'll be very profitable. Realistically, I'm not that good at maximizing my wins, but I am really good at minimizing my losses. Like really good. I have a really good system for reducing my risk on trades. And that allows me to be profitable. If I can improve my ability to maximize wins as well, my profitability will only increase in the long run. And it's something I'm actively trying to work on. Obviously, I'm not perfect. This is something everyone probably has to improve on for the rest of their trading journey, period. So, step 1, identify high probability losing trades. So what does that mean? While you're in the trade, you have to identify, based on price, where price should not go. And if it goes there, it's low probability that the trade will play out. So what can you do when you identify low probability signatures? 1, you can exit the trade early, right? As long as you close the trade early, whether it's, moving your stop loss closer to entry or just terminating the trade early if you start seeing bad signs. When's the last time you closed the trade early because you saw bad stuff? I never do it personally. I always, I have a system in place, but I've never just market closed the trade just because it wasn't looking good. I always hold on to like hope or something, which can be good, also can be bad. You're going to have to balance that. But anyways, that's one thing you can do. Something else you can do, which doesn't get talked about a lot, is beginning the trade with less risk to begin with. If you want to risk $1,000 on a trade, who says you have to risk $1,000 at the very first entry? Maybe you want to start off with $750, and then later on, maybe you add a couple contracts to make that risk up to $1,000. Once you get more feedback and more information from the trade, you can identify, is this more likely a winner or a loser based on what happens after you enter, right? Most trades you take, if they don't start playing out from the beginning, it's probably going to be a loser unless you're some sort of swing trader. Finally, you can take portions of the risk off. So meaning you can decrease your winners by taking partials. Decrease your losers by taking partials, because when you take a partial, your stop loss is reduced. However, this can also decrease winners if done incorrectly. So you have to find a system where it makes sense to take profits so that your partialing system brings in more money in the long run than takes away, money in the long run, whatever. You guys get what I'm saying. Okay, so that's everything for the PowerPoint. I'm going to get into the charts now. We'll go over some examples and I'll break down what I do, and I'll give you guys some tips and tricks. I'll teach you guys the TP method, and I'll see you guys in like 2 seconds when I switch over to the charts. Okay, so this is an example from today's price action actually, and this is obviously going to be somewhat cherry picked, just so I can demonstrate how I manage my risk. If you guys want not cherry picked examples, well, I live stream every single day. I post trade recaps often. I show my executions. I show my P&L. I'll do live trade walkthroughs where the trade's playing out and I'm commentating over it. So again, hopefully no one complained that this is cherry picked. The goal is to show you how I manage my risk and obviously some other methods. So let's say hypothetically you are bullish in this point of time and you're going to enter with 10 contracts long. Now I want you to focus on the dollar amount of risk. I know it says ticks, so just give me 1 second. Focus on the dollar, okay? So let's say we started the trade. Let's get an easy number here. Let's just go to $1,000, just so the number is easy. You know what? Let's do $1,500 because that stop loss doesn't really make sense. So we're risking $1,500, and our take profit is, let's make it simple on us, $2,500. So remember this, please. These numbers are important. This is called the original SL, or the original risk, which is $1,500, right? And then the original take profit, and I'm going to show you guys something here that's really important, $2,500. So let's talk about how you can manage risk on this trade. So first things first, when you enter a trade, what are you looking for? Forget everything. Forget the TP, forget the SL. You're not looking at that. Your job now, you did the hard part. Now what you have to do is identify high probability signatures that will tell you, is this trade high probability or low probability? That is your goal. Every time I enter a trade on live stream, you guys hear me what I say. I always say, what I'm looking at now is, can we get above this high? Can we inverse this fair value gap? When we dip, can the bodies show support, etc., etc.? I'm always looking for signatures of a high probability winner or loser. Why am I looking for that? Because that will tell me what to do with my risk management. That's the most important part. Cut the winning trades early and find a way to maximize winning trades if there's signatures. So we enter this trade. We're looking for $2,500 target and $1,500 loss, okay? Let's play out a couple minutes and let's see if we can find some signatures. So what do we see here? We waited a couple minutes. Price comes into first presentation fair value gap and we get an order block here. Now, why is this an order block? I will explain why this is an order block. So this is actually what I call my protraction model. So if you go to the 2-minute chart, you'll see it very clearly very shortly, sorry. This is a bullish fair value gap, right? So you guys see that bullish fair value gap. The market trades down into it, and then we close above the down close candle. So to me, this is now a bullish order block. And I don't know where the trade went. So allow me to just go back, put the trade back on. And just go back to where we were. So like I said, this is a bullish order block at this point in time. Oh, is that why? Okay, sorry. You guys are going to have to watch me do this twice because I accidentally went back in time. Okay, so this is a bullish order block. And like I said, we were risking 1,500 on the trade. So let's just put that, around 1,500 and take profit 2,500. So this is the trade. Now, we have gotten positive feedback from this trade. In fact, I would go as far to say that this is a high probability signature. Now, if you guys know how I trade, I almost always, I'll say 8 out of 10 times, when we put in a protraction model low, I always bump my stop up to this low. So just like that alone, we now moved our stop loss from $1,500 to $90. Let's say you don't want to put it here. Let's say you even want to put it here, right? Say you saw this bullish fair value gap and you're like, you know what? Maybe it'll come here. Okay, you put it at the bottom. That's $600 risk. Say you put it here. That's $850. You were risking $1,500 to begin the trade. Even if you put your stop loss somewhere here, you are now risking half of what you were originally risking. That's amazing risk management. That's amazing. Because now if price came back and you got stopped out, well, the trade's not likely a winner. And, well, you lost half of what you originally risked. So what can you do in a situation like this? Not only do we know that this is a good place to put our stop. Why? Because it covers this low and this fair value gap. So this stop loss actually makes sense, right? If price comes here, the trade's probably going to fail. It should not come here. Not only that, price shouldn't even come here. There's a really good chance that it's going to continue. So what can we do? We can add contracts. So notice, I added 5 contracts. And what am I risking now? I'm risking 1444, so basically 1500. My risk is never increasing. My original SL is 15. Now I'm risking 15. So what changed? My take profit. My take profit now is 3,500. So I am looking to make an extra $1,000. In this case, that's an extra 1R around, just under, on the trade. And I never opened myself up to more risk. And then obviously with the power of hindsight, we see this trade plays out. You can even go as aggressive to say, okay, let me put the stop here now, and we're getting really close to TP. I'll add 5 more contracts. Now we're looking to make around 4,000, for example, right? And then you can see, obviously, with the power of hindsight, we managed to reduce risk. And not only did we reduce risk, we also added contracts. Now, why did I add contracts? Because I got a protraction model. So you need to identify for yourself what you need to see to add contracts and reduce your stop loss. But hopefully you guys can see the importance of moving your stop loss and adding contracts. We're maximizing on a winner. Now, let's talk about runners, okay? This is a very important lesson. So, in this trade, we had London High over here, okay? London High, and this was our original target for the trade. So, London High is only 82 points away. Our entry is 120 points. So if we are going to leave a runner on this trade, and remember, we moved our stop loss to, let's say, here, right? This is basically the trade we're leaving for our runner, right? Our stop loss was here, right? Or let's say our stop loss was here, for simplicity's sake, because we moved it up. We're looking for a 1R runner. Is that worth it? You have to ask yourself, this is the runner that we're looking for. London High is over here, and my stop loss is here. Maybe you want to move your stop up. Okay, that's a different story. But let's say it's like this. It's 1R. If you can ask yourself, will this play out? And at this point in time, will this play out more than 50% of the time? If so, this 1R is worth it, right? In my opinion, this is probably not really worth it as a runner. I think there's a good chance that we take out the highs here and then fall short. I think there was also an SMT. But again, that's all subjectivity. You need to decide for yourself. Just what I want you to take away from this is, where's your stop loss now? Where was your take profit? And where's your runner? This is not really a runner. You're looking to make an extra you're risking 80 points of profit to make an extra 80 points. That, in my opinion, is not worth it for a runner. What's worth it for a runner is if you say, you know what? I think we can get to midnight opening price. That's worth it. Why? Because even if we don't get there so often, if this is going to run, it's a runner, right? This isn't a scalper. This is a runner. If this trade is going to run, let it run. See how far it can go. Maybe it doesn't get there. Now, obviously, with the power of hindsight, we do. And that's irrelevant to what I'm trying to explain. What I'm trying to explain is, you have to ask yourself, is it worth to give up this potential profit for 1R? Maybe not. Maybe it is. I don't know. You have to ask yourself that question. Is it worth to give this amount of profit up for this? Depends. How often will we go to midnight open, right? In my opinion, this makes sense because even if it only works out a couple times out of 10, you'll make a lot more money than you'll lose. But for the 1R, it's maybe not be worth it. I'd rather just take it off here, secure the money, and walk away. That's just a question you have to ask yourself, right? Now, when it comes to taking partials, that's a whole other concept. You need to study your trades and ask yourself 2 questions, right? If you take partials, When do partials hurt me? When do partials help me? And you need to ask yourself basically these two questions. They will hurt you when you take partials on trades that run a lot more, right? So you need to work on that. They also will help you when you take partials that on trades that would have fell short anyway. So you're actually making money when the trade was wrong, right? And it goes in your favor. You have to weigh the pros and cons. You have to actively try to make a system with partialing in order to seek the benefits. Because if you take partials too early, you're going to average like negative RR. You're never going to be profitable. All your winning trades are going to be less than your losers, and it's going to be really, really hard. You're going to be going against the current. Remember, it's not about winning this trade. It's about if I did this trade for 100 times, would I be profitable, right? That's what you have to ask yourself when it comes to risk management, right? Risk management is if I did what I did today 100 times, will it help or hurt more? And then obviously you want to keep in mind the equation. The equation is, right, net wins must be greater than net losses. If you're always taking partials early, right, and I'll move my camera there. If you're always taking partials early, right, they're not even helping you at that point. You might as well just let it go to 1 or 2R and take it off at full because you're cutting all your wins short and your losses are going to be full size. So again, that's something you have to outline. So hopefully that makes sense. I'll give you guys one example of a trade where I feel like I scaled in pretty well. So I'll just throw the image here on the chart. The image is too large, so I'll just zoom in here. So you guys can see an example. This is a trade I took on my live account. I got short inside the suspension block off the inversion. My stop loss was right here on my cursor. And then the market goes down, pulls up, and then breaks down again. When it goes down, I short that right here. So inside this order block. And I moved my stop loss right here. So I'm never risking more. My stop was here. It went to here. Then I added contracts. Why did I add contracts? Because I got positive feedback that the trade was likely to go down here in the form of this bearish order block. So I'm taking that trade. And this trade was only around 1.25R. Once I added contracts, I made more money on the trade around 1.85, something like that. I don't remember the exact numbers, but you guys can get the idea. Now, if you want to see more of this, I live stream every single day on YouTube. I'm more than happy to show you guys my risk management. Again, I'm not the best. I'm not claiming to be the best person when it comes to risk management, but I will always look to improve. I very, very highly value reducing risk in trades. In my opinion, reducing losses is a lot easier than maximizing wins. Maybe it's a personal thing that I need to just work on, but I'm really good at minimizing my losses. I'm really good at moving my stop loss up to levels that should not be met if the trade is valid. So that's something I exceed in. And I personally think, well, in fact, I know it's enough to be profitable because even just good enough win rate in RR is profitable. If you can also reduce your risk on some losses, that's really, really good. I got to work on personally maximizing my wins. Although, like I said, that's one example on my live account. So this is something I'm looking to actively improve every single day. And I think you guys should do the same because at the end of the day, profitability is risk management. It's one without the other is impossible. And that's everything I wanted to cover in this video. So I appreciate you guys watching. Hopefully you learned a thing or two about risk management. And I will see you guys on live stream. Peace.